Okay, so welcome again. My name is Angie Knoll. I am the owner of Reconciled Solutions. And our goal is to help people have visibility and clarity to their financials so that they can run sustainable and profitable businesses. So that's what we do. It's National Financial Literacy Month, and we wanted to honor that with this webinar about decoding financial statements. One of our core values or our immutable laws at Reconciled Solutions is that we act with the heart of a teacher. And this begins with the financial statements. We want everybody to be really clear on how to read their financial statements. How effective of a business owner can you be if you don't quite understand your financial statements and the juicy story that they're trying to tell you? And they are really trying to tell you a juicy story. So we want you to be able to see that and to be able to decipher it and to make action based on what you're seeing in those numbers. Okay, it's not as much of a gut as it is as, hey, here's living proof, here's the numbers. So we don't know what we don't know. That's what I would say. And we can take power back by just understanding our financials better. People are scared of their financials. There's anxiety. There's a mystery about them, right? We're not necessarily set up to be financial oriented people. So sometimes we don't look at our financial statements enough. There's a lack of knowledge there. So all of these things are things that we hope to overcome in terms of talking about financial statements. So today we're going to start doing that in 3 ways. First of all, we're going to talk about the chart of accounts and just explain what the heck is a chart of accounts. And then we're going to be looking at a profit and loss report, and we're going to be looking at a balance sheet and a statement of cash flows. Now, if you have questions at any time, Kitty is opening up our chat room, and you are welcome to post questions in the chat. She'll, prompt me to make sure I get your questions answered. And again, I'm happy to answer questions throughout this presentation, so no worry about that. So the first thing I'm going to do is open QuickBooks Online. The first thing we're going to do is show you that there's this free test file for QuickBooks Online. It's called Craig's Design and Landscaping Services. This is a great place to go and try anything you need to try in QuickBooks Online. It will erase after you close your browser, and it will be back to the same data. So the first thing I wanted to show you is that to get to that, all you need to do is type in test drive QuickBooks Online. So there's that secret pass to a free QuickBooks Online test file in case you're trying to do any work there. Here's the QuickBooks Online test drive. So that's all you need to do. You'll be able to click into it from there. So this is the QuickBooks Online company file. And I love the first page of it because it kind of gives you some arrows and mapping of how things work in QuickBooks Online. We're going to be talking first about the chart of accounts, and I want folks to understand what a chart of accounts is. It is a recipe index for your business. So in our business, in most recipe books, there's like the poultry section, there's the appetizer section, there's the desserts section. Those are the different headings in recipe, right? And that's in the index. And then in the index, if you want to look up how to make apple pie, you're going to go to the pies section and find out what page the pies recipe is on. That is not unlike a chart of accounts. In a chart of accounts, what's on the menu is bank accounts, liabilities, assets, equities, income, cost of goods sold, and expenses. So there's about 7 sections or indexes in our chart of accounts. And at Reconciled Solutions, we're very particular about the way that those are set up because we want folks to be able to read their financials, their financial statements really clearly. So the first thing I'm just going to show you here is the chart of accounts for this sample company. So you can see here, we mentioned bank accounts, we mentioned assets. What else did we mention? We mentioned liabilities, equity, income, and we also have on here expenses and cost of goods sold. So those are all the different sections in our index, okay? And they each have different functions, and it's to keep track of what's going on in your business, okay? So that's something that I wanted to start with. I'm going to share with you the handouts, spending a lot of time in the handouts today. You'll be receiving these after the call, and there is a glossary of terms here. So some of the most common terms I've included so that if you can't remember quite how it all pieces together into the puzzle, you'll be able to look at this glossary of terms and go back and review those different things. So the next thing we're going to be talking about is the profit and loss report. This is what we're looking at, and I'm going to be taking questions and comments as we review this, but I also want to show you how you see a profit and loss in QuickBooks. So if I were to go to reports, there's a whole bunch of standard reports here under this standard tab. One of them is a profit and loss. So we can run a profit and loss statement. This one is for January 1st of 2023 through April 11th today of 2023. And we can see some of those different categories again from our chart of accounts. All the income is here. All the cost of goods sold is here. So this is our total cost of goods sold. That amount for this company is $405. But they did have labor here too. So the landscaping services labor cost was $5,827. So if you added that labor cost up with the cost of goods sold, which would be the material, you're going to get what's left, and then that's going to lead to your gross profit. So your gross profit is going to be your income. In this case, total landscaping. So I said that wrong before. The total income is $9,444.52. And the only cost of goods sold we have is that $405. So if you take $9,444 minus the $405, your gross profit is going to be $9,039. So that's your gross profit. That's what your real revenue is. I like to refer to it as real revenue because the expenses that come after this are more operational in nature. This $405 is representative of what you spent to get your product or service out the door. Okay, hopefully that makes sense.
I have a quick question from somebody.
Yes.
They say, are you going to be talking about corporate annual reports? They often don't look like traditional P&L. They often list sales, cost of sales, etc., not sales, salary, professional services, etc. And then I also
we're just talking about profit and loss, balance sheet, and statement of cash flows today. Okay. So most of the companies, this is geared towards companies that are using a traditional profit and loss. So let's say $100 million. Okay. All right. So that's what that's where you find that profit and loss report in QuickBooks. And then we're going to go to this sample profit and loss report that I have here ready for your review. Okay, so this is one of our clients whose information has been changed. So we can take a look at what the profit and loss report is telling us. So it's really great because it has all the pieces that I was telling you about are really important to me as a business owner, and I can tell how profitable we are. So the things that are really important to me, obviously, is how much income we're right? And I want to know how much the cost of goods sold is. We often work with service-based businesses like creative services, lawyers. We often work in the healthcare industry. All of those people are exchanging knowledge for money. So there might not be a physical product to what they're selling. In this case, there is a productivity cost. So I wanted to point out that if we're thinking about a business as cost of goods sold versus operational expenses, that productivity lends itself to the cost of goods sold section, meaning that there's a direct relationship to your revenue. So that is one of the major categories we use in our chart of accounts when we set up the books for somebody, is a productivity cost. And some of the other ones that are really important to us are general and administrative. I have to tell you though, general and administrative, this is the junk drawer of your company. It's where you dump everything that you don't know where to put. So if you're looking for ways to cut back on expenses, this is a good place to look under your general and administrative costs, because things get kind of dumped into this category. So we use general and administrative as one of our biggest categories. We use payroll, and that's related to all payroll expenses. And the other big category that we use is occupancy. Okay, and that's for the rent or lease of a place of doing business and all the expenses to keep up with that location. Okay, and then productivity is often reflected in the cost of goods sold. So those are kind of our four big categories: productivity, general and administrative expenses, payroll expenses, and your occupancy costs. If we take a look at this client's financials, we can see that it's a creative services company, and they have income for January through June of 2022 at 1.3. That number is here. Okay, that income is divided between branding, post-production, web launch, web grow, web support. Okay, so all of that adds up to this total, right? Along with the billable expense income and the affiliate income. So that grand total is 1.3 million. Now, what I want you to realize is that what we have established the costs to align with the revenue. And that's a super, super important concept, because then we can say, okay, well, web launch, this is the biggest seller for the business, and it's 31.77% of all the revenue we collect. That's what this percent of income is. So as a percent of income, web launch is almost 32% of everything, of every dollar we bring into the company. Now, how much does it cost us to provide those web launch services? Well, I'm going to want to know that individually. So I would go down and look in the cost of goods sold and see if I can do a direct match with web launch. In this case, there's not necessarily a direct match, but there's some pretty good stuff here as far as getting into the costs. And the reason I would want everybody to be able to do this is because we sell things at different prices and they cost different amounts. So if you've ever heard of a lost leader concept, that's something that you might sell very, very cheaply. It costs you quite a bit of what you're selling it for to put it out on the market. But the result then is hopefully you're going to get clients in a different area that's going to produce better margins. So being able to identify that kind of stuff, those silos of income and expense, are super, super important, so that you can say, okay, we have a very profitable business in web launch, but we're not doing as well in branding, for example. Okay, so that's something that's very important to go through.
And I just wanted to interject and let everybody know that the chat function is not working for this webinar. It's not an option for this webinar. So please use the Q&A that you'll see at the bottom of your screen. I'll be monitoring that.
Okay, thank you, Kitty.
And Angie, your sound is going in and out a little bit. So I'll keep you posted if you need to switch off your microphone and go on the laptop device.
All right. All right, thank you. Okay, so the next thing I wanted to talk about is that gross profit number. Okay, the gross profit number is expressed as a percentage. So in this case, the gross profit for this company is 85%. That means that their production cost was only 14% of the total income. Again, that total income was 1.3 million in this situation, and then they spent 195,000, as we can see here in line 33, on delivering that product to clients. And therefore, the gross profit was $1.1 million. And that's 85% of the total revenue of 1.3 million. So those two numbers are very, very important to your business. How much does it cost you to produce and deliver your cost of goods sold, or your product or service? So for example, in construction and trades industries, we often see that 60 to 70% of their revenue is cost of goods sold and cost of delivering that service. In some service-based businesses, it can be much, much lower than that. So in this case, 85% of their total revenue is gross revenue. That means only 15% is expenses. I would say typically in a service-based business, it's somewhere between 30 and 60% of your total revenue is going to be used to directly provide that. So production cost. Okay. So then the opposite of the percent of cost is the gross profit. So I said 30 to 60% for a service-based business is the cost. So that means that 40% to 70% is your gross profit. Okay, and in this case, it's 85% is gross profit. We also talked about trades industries, and they're spending 60 to 70% on production and delivery. So that means that their margin, gross margin, is going to be 30 to 40%. Okay. As we go through the expenses, then I wanted to point out what some of the things included under general and administrative. It would include advertising and the things that go along with advertising. This person has auto expenses in there. So there's an auto getting written off to general administrative. You've got your bank charges and fees, computer software and expenses, dues and subscriptions, got legal and professional services. You've got accounting, insurance, all of that kind of stuff. If you have a business coach, that would be in that legal and professional services. Office supplies are going to be in there, postage and shipping. All that stuff is a part of your general and administrative expenses. Okay. From there, we're going to have payroll. It's a separate category. Payroll is typically the biggest expense or one of the very biggest expenses for a small business owner. Okay. In this case, I wanted to take a look at the payroll and how it's put together here. So we can see that total payroll expenses are on line 1 for this company is 449,000. Let's round that up to even 500,000 for the company. But there's different ways that that payroll expense is spent. So here's some of the different ways. Okay, they've got a 401k. So there's expenses for administration of a 401k. There's other benefits that are being provided. Now notice these next three lines, yep, 80, 81, and 82, all begin with the word partner. So in this business, there are partners in the business. So it's not one owner. And we are calling out that the partner is recording their dental premium, their medical premium, and their vision premium separately from other employees in the company. So that's really important because as a business owner, we want to be paid in two ways for being a business owner. One is based on our contribution to the company. That's our working every day in the company and the work that we do for the company that provides the company sales and deliverables. And the other way that a business owner gets paid is through distributions, and distributions are rewards for the risk that comes with being a business owner. So that's big on our minds because we want to be rewarded for this very difficult job of trying to grow a small business. It is not a simple thing, a straightforward thing to grow a small business. So not only do we want to be rewarded for the work that we actually do through contribution, we also want to be rewarded for the risk that we have taken as a business owner. And this would be being able to take distributions as a owner of the business, profit distributions. So we're able to take distributions based on the profitability of the business. In this case, we can see that there's two owners, Jane Doe and John Doe. Each of them are on wages and salaries. They have a payroll set. They were each paid $75,000 for the year or for those 6 months. So they would be, if this is a 6-month review, then they would be paid $150,000 over the course of the year. I want you to remember that those are payroll expenses. And what that means is that the taxes have already been paid. So it was 75,000 or maybe it was 5,000 on the paycheck, but the actual amount that went into the owner's bank account is, let's say, 4,400, right? So the differential there, that $600 between the $5,000 pay stub and the $4,400 net pay is paid to taxing agencies, right? So you've already paid taxes against this $75,000, okay? So that's what that looks like. And then we've got other wages. We've listed them as staff wages. And you can see that there are different job titles here. It's really nice to be able to have job titles or grouping responsibilities in your payroll expenses so that you can see the efficacy of a given job responsibility. So we've got the general and administrative people, which might be an office manager, it might be an executive assistant or a virtual assistant. Those are folks that are general and administrative in nature. And then the people that produce are not general and administrative. So they're producers, right? So there's all of that going on. And then the other thing I wanted to say about it is some people may have sales commissions. So if you're paying somebody based on the revenue they produce, so it's a direct result of the revenue they produce, that is a part of your cost of goods sold. Okay.
Angie, I do have a question, and maybe you've answered it. The question is, as a service business, is the payroll and payroll costs to be listed as COGS or as an expense?
It depends. There's different situations. It kind of depends upon the cost or on the business. So my favorite example is a dog walking business. Okay, in a dog walking business, there's often many people walking the dogs, but there's only one administrative person. And those people are paid as a result of how many dogs they walked and how many walks were taken. So if I walked 3 dogs today, I get paid a portion of 3 dog walking fees. To me, that is a cost of goods sold. That dog walker has nothing to do with the general and administrative operational expenses of the company. It's a direct relationship to the revenue they produce. So to me, if it's a direct relationship to the revenue produced, it's going to be under productivity, which can be up in the cost of goods sold section. You can also have a productivity within your payroll, but again, you'd want to do that by like a job title or a group of titles. In my business, it's accounting services, right? So Kitty does, she does sales and marketing for us. And so the cost of her payroll goes under my general and administrative duties, and the cost of the accountants that I hire and the results they produce goes under accounting services as a payroll expense. Okay, so payroll is likely the biggest cost you have for your company, and you have to be super mindful of it. We're looking for a 2 to 4 time return on investment. Okay, so we have to think about that when we're considering hiring that next person. Like, can I afford to hire the next person? Well, how much revenue will they generate, or how much will they take off the owner's plate so that you can be more efficient yourself, right? And so in this case, like, we can see content production, there was $30,000 of expenses in the first 6 months of the year. So if content production revenue was, let's say, 2 times, that would be $60,000 of revenue in content production, or 4 times, that's $120,000 of revenue in content production. Then I would feel very solid about having that person in that position.
I have another question for you. If if staff members are very limited and almost each employee is having a different role, in this situation, do we really need to maintain multiple payroll expense accounts for that unless client asks us to do so? Can't we simply have 2 or 3 payroll expense groups?
Yes, you definitely can have 2 or 3 payroll expense groups. I would just keep your operational expense separate from your production expense, and you can list it that way. So in that type of business, you've got production expense, you've got general and administrative payroll expense, and you've got owner's pay. Okay, so then the next section that we have here is occupancy. So, you know, those are typical things that you would think of. You've got utilities, gas and electric, telephone, that kind of stuff. You've got the rent expense. This business has 2 locations. So the total occupancy is 57,000 for the first 6 months of the year, which is 4% of their income. Okay, so total expenses then for the business are $666,000. That means that they have a $452,000 net income. And that is a beautiful net income based on percentage. 34.44% here is the net income. So that means for every dollar brought into the business, 34 cents of it is profit. It's pure profit. What a lovely margin. If we could all have businesses that had 34% margin, you know, we'd all be booking Jeff Bezos's trip to the moon, right? So that's a beautiful thing.
And Angie, here's one you might want to touch on again, because there's a question: is owner's pay synonymous with owner's distribution?
Okay, so that's a very good question. And they're different from each other in that it depends upon the entity type that you're in. So a lot of folks are sole proprietors or a single member LLC. In a single member LLC or in a sole proprietor, the owner is not paid through payroll. They are paid through owner's distribution. So imagine this profit and loss if you took off that 75,000 or the 150,000 of wages paid in partner compensation. So then your net income is 450,000. It would go up to 600,000. Okay. And then we would see on the balance sheet how much the owners took out to pay themselves via owner's distribution, partner distribution. Those are the different ways they're typically listed. Okay, in an S Corp or a corporation or an LLC partnership, which would be an LLP, we're typically seeing payroll expenses for the owner. Okay, so then that means that those payroll expenses being paid to the owner are having taxes paid on them right away. The difference between a payroll expense for the owner and an owner's distribution is that when you're taking a distribution, there's been no payment to government agencies. So you get 75,000, you get 75,000. In when it's on your profit and loss, you get paid 75,000, but you actually only got 58,000, right, in net pay into your personal account. The other thing that I would want to mention here then is this net operating income. This is what shows taxability. Okay, so if it's a loss, if it's an income, this is where your taxability comes from. Okay, so that is the number that you carry forward. And when people say, how much money did you make this year? It's going to be reflected in that net operating income. Okay, that's super, super important. Okay, so that is the profit and loss review. I'm going to start with the balance sheet unless there's any other questions there.
No other questions, but one of our people has a 65% profit margin. So he said, they say,
congratulations. Woot woot.
And then there is another question that just came in. Is there a golden ratio of how much distribution versus payroll an owner should do?
Oh, yes, there certainly is, but based on the person that you're talking with. There's a couple of things that the IRS looks at, and you're probably able to find some articles on my blog about this, but a couple of things that the IRS is looking at is reasonable compensation. You'll hear that term thrown out there a lot. The IRS is expecting that you are paid reasonable compensation. So in this business that we were just looking at, the partner's compensation was $150,000 and the revenue was 1.3 million. So the question is that reasonable? 150,000 out of 1.3 million? I don't know, sounds pretty reasonable to me. Another question that you might ask is, if I had to hire somebody to do my job, say I got sick and I couldn't do it, and I had to hire somebody to run this business for me, how much would I have to pay them on the open market? And am I being paid similar to that amount based on what that job title and responsibilities garner on the open market? So those are a couple of criteria. It gets, it gets pretty complex. Different accountants will do it different ways, but those are a couple that you're going to hear over and over is reasonable compensation. And also it's based on if I had to hire somebody to do my job responsibilities, how much would I have to pay them?
And we have another question. Why is other income added after net income?
Well, so there's a few things down there. That's a great question too. One is credit card benefits. So you hear people say all the time, oh, I'm using my credit card so I can get the points. Then they're going to use those points for travel or whatever. So that's one. This client has an employee retention tax credit. Many of you might have received PPP loans that have been forgiven. Those are examples of things that that you received money for, but it wasn't your product or service, so to speak. So the other income stuff tends to be taxed differently than your revenue from products and services provided. Okay, so now we're going to the balance sheet. So balance sheets, people get so confused by this. It has a lot less to do with the day-to-day activities of your business than does a profit and loss. The balance sheet is a financial picture at any given time of your assets, and that is going to be equal to the liabilities and equity in your business. So let's go through that. Assets equal to liabilities and equity. So it's a summary of those different things. So what is an asset? What is a liability? And what is a equity? We'll talk about each of those individually. The first section is the asset section. So here's our total assets for this business owner, $461,582. Okay. Now, that is made up of a few different moving parts. These are the bank accounts. So this is just money sitting in a bank account or sitting in several bank accounts, savings, checking, all of those combined. There's a cash on hand account here. There might be a petty cash drawer in your business. This is cash on hand, and that is part of our assets. Another part of our assets would be security deposits. Okay, so this is money you put down to rent a place. So things of that nature. If you have expensive equipment or if your business owns a vehicle, those are part of your assets. So you bought a $50,000 vehicle, you have $50,000 on your list of assets. Now you may have a loan for $49,000 of the $50,000, but the asset portion of it is that vehicle is worth $50,000. You buy computers, that's typically on your asset list. Another thing that's on your asset list is undeposited funds. This one is kind of ugly here at $110,500. Here's what undeposited funds are. They are income that your business has received, but it hasn't been matched to the person, the client, so to speak. So what happens in QuickBooks specifically is that you provide services. Somebody pays you for those services provided. It comes in through your bank feed because you've hooked it in through your bank feed. And then on the bookkeeping side, we say, oh, Angie Knoll, she paid $3,000. And here there's an $100,000 that Angie owes that money. So we connect those two. And once we connect them, then it leaves undeposited funds and it goes over to your profit and loss on the income statement. So in the interim, it's often in undeposited funds. And if we have a big amount sitting in undeposited funds, that's a little bit of a red flag, because what it could be telling us is like, this isn't matching to people who owed us money, right? Like, do we sit around and have $100,000 checks on our desk that we haven't actually deposited at the bank? That's very unlikely, right? So more likely is there's a disconnect in your accounting system that's attributed to undeposited funds, because we have to say, for every client, we have to say, client owes us this much, client paid us that much, and they have to connect to each other, okay? So that's what undeposited funds is. There's fixed assets. Those are things that last longer. So an example would be the like some of the machinery that we were just talking about. Another fixed asset might be another fixed asset might be like a trademark. Okay, trademarks have value, or patents, they have value. So those are examples of things that are intangible but have value, they carry value. Another thing I want you to realize is that most small businesses operate on a cash basis. So the difference between cash and accrual accounting shows up on your balance sheet, because a cash-based business will not have accounts receivable, where an accrual-based business will. So let me explain cash basis versus accrual basis. A cash basis business is one that shows revenue when revenue is received. So if Angie owes $3,000 and I haven't paid it yet, that means nothing's happened in my accounting, right? There's no accounts receivable. Angie owes the $3,000, but it's not considered a transaction until Angie pays the $3,000. And the same thing on expenses. If you booked a conference that you're going to travel to, and it's not yet hit your bank account, then that is non-existent in your business on a cash basis. On an accrual basis, it means that when you book that conference and spend the $1,000 to get to the conference, it shows in your accounting. And when Angie owes $3,000, it shows in my accounting, regardless of whether I've paid it or not. So it's been an activity that happened in my company, and therefore it must be recorded. So that's the difference between cash and accrual. Now back to accounts receivables. This company is a creative services firms. Chances are they have a whole bunch of outstanding invoices for web design or web content or what have you, and a bunch of folks that have not paid. However, it does not show on their balance sheet because they are on a cash basis. So if they were on an accrual basis, it would show that Angie owes $3,000, and that would be considered an asset to the business, because they know they're going to be able to collect from me that $3,000 that I owe. And you can see that in QuickBooks. It's very easy to change your reporting in the accounting method right here from cash to accrual. So in this case, let's just take a look at this profit and loss statement. So your total income is $9,444.52, and that is on an accrual basis. If we check cash, let's see if that amount changes. So then the income comes down to $4,689. So we can assume then about $5,000 of the total income has not yet been collected. So we can switch very easily in QuickBooks if you want to know how much is coming. You know, like I need to project if I can pay my bills or not. You can switch it to accrual. Okay. All right. So back to this. Okay, so those are some of the things that are considered assets to the business. And in this case, the assets are 461,000. Okay, then it's liability and equity. So the liability and equity has to add up to 461,000 too, because assets are equal to liabilities plus equity. Okay, so accounts payable, this is people you owe money to. So that $3,000 that I might owe you for the services that you provided for my company would be on my accounts payables. Reconciled Solutions would have a bill there that I have to pay $3,000 to you for the delivery of the services you provided me. Okay, so that's what it is. Again, accounts payables and accounts receivables do not show in cash-based accounting. They do show in accrual-based accounting. So in accrual-based accounting, the accounts payables is a liability. It's something that you have to pay to people. Okay, so that would be one thing that's considered a liability. You'd also see credit cards. So credit cards are such that you charge all month long. They send you a bill at the end of the month. You may pay it in full. You may pay partial on that. So if you paid it partial, there's still a remaining amount there. That's a liability to your company. It has to be paid. Okay. The same thing can be said for loans. Okay. So in loans, those are, that's money you borrowed. Okay. So here we see the SBA EIDL loan, Economic Injury Disaster Loan. So this company took 199,900 as a loan. That was cash that came into the business, and then you pay it back over time. So it is a liability to that business. The other big section here is the payroll liabilities. Payroll liabilities. Here's your payroll liabilities, and they are representative of that stuff that has been withheld from the paycheck of an individual, but not yet paid to the correct agency. So I think the example was that it was 75,000 paid to the employee, or in this case, it was a partner, 75,000. They only got, say, 55,000 of that deposited into their personal bank account. So that 20,000 is sitting there, and it has to be paid to their 401k. And they owe some to the life insurance or the health insurance. So that money, when it sits there, and namely to the IRS and to Illinois, if you live in Illinois or whatever state you live in, those are your payroll taxes, right? Your 941s. So all that money, the difference, the 20,000, is a payroll liability because we withheld it from your paycheck. We have not yet paid it to the agency. Okay, so that's why those are payroll liabilities. So then your total liabilities in this case is 240,980. And remember that I said assets need to equal liabilities plus equity. So the assets are 461,000 and the liabilities are 240,000. So we still have to come up with another half of that in equity to represent that cost of the equity. They have to be equal to the assets. All right, so under equity, there's capital stock. All right, this business that we're looking at is an S Corp, and I find that a lot of small businesses are S Corps. In an S corp, the net income of the business is recorded on a K1 statement. So you may have heard a K1 statement. That K1 statement goes and passes through to your personal tax burden. So if I am an owner of this company, I was paid $75,000, and then on the profit and loss, the net operating income was $452,000, and I'm a 50% owner, so that's like, you know, $225,000. That $225,000, my 50% share of ownership would be reported on a K1, and it would be added to the $75,000 W-2 I received, and then I'd be at 400 and what did I say? So I said 225 plus 75. So then I would be at $300,000 of personal income. Okay, that's how that gets reported. So that would be reported on the K1. There's partner capital and there's partner distributions. So partner capital is when you're paying your own money into the business to build the business. So that could be for startup costs. It could be a loan from yourself. Anytime that you have to borrow money from your personal bank account and put it into the business so that the business can run effectively, that is a partner capital contribution. And then the partner distribution is you taking money out of the business for your own sake. Okay, so let's say you went to the store and you wanted to buy a new TV, and you grabbed the wrong credit card and you paid for it with your company credit card instead of your own personal credit card. We would book that to a partner distribution, because it had nothing to do with the business. It should have been a personal expense, and we're going to put it under partner distributions. Same can be said if you pay for it from the personal when it should have been a business expense. So say you grabbed your wrong credit card to pay a $1,000 bill. It was a business expense, but you paid for it with a personal credit card. We would then bring that into the business via a partner contribution. Okay, so we want to know what those partner contributions and distributions end up being at. And they zero out every year. So at the end of the year, if the net income of the business was 452,000, wasn't that what it was? Profit and loss, 452, or down here the net income is 467 after the other income and other expenses. 467 comes over onto the balance sheet right here. That's the net income. And then I said, like, you would get a K1 statement for that. So that's where it would show. Okay. If throughout the year you're taking distributions, then we zero that out when we're going into a new year. So in this case, we've got Jane Doe, who took $102,000 of distributions. And what we would do is then when January 1st of the new year came, we would move the $102,000 from distributions to retained earnings so that it shows it's a new start. Okay, retained earnings is the cumulative total of all historical profits earned by the company minus dividends. Okay, so that one's a bit confusing. I'm just going to explain that once more. And what I wanted to say, I just wanted to do an example for you. So it's cumulative. To give you an example, if your company made $100,000 of revenue in year one, and then in year two, you lost $20,000 of revenue, then your retained earning at the end of year two would be $80,000. It's $100,000 minus the $20,000 that you lost. So say now in year three, you made $30,000. So you're at $80,000. You have a new net income of $30,000. So that's $110,000. That would be your retained earnings. Okay. Any questions on the balance sheet or any questions that I can answer?
There's no questions in the Q&A, and just so you know, it's 12:56.
Okay, so then I think we'll wrap up. The only thing I wanted to say about statement of cash flows is it's just the money coming in. It's a measurement of the money coming in and out of your business. And there are three ways that money goes through your business. One is through investing. Another is through borrowing and debt, liabilities kind of stuff. And the third is through operational expenses. So those are the things that are measured in a statement of cash flows, is that we're showing the amount of money spent on investing activities, the amount of money spent on borrowing activities, and the amount of money spent on operating expenses, operating activities. Okay, that's it. I'm going to give a couple of things here. One is an offer for a free profit assessment. It's on my webpage. And Kitty, can you put the link to my webpage up in the chat? It's under freebies if you want to do it. And it's our first thing, take our free instant profit assessment. So that would be a meeting with me. It's a 20-minute long meeting, and I'm happy to meet with you and review your financials a little bit to help you understand if your company is currently operating profitably or you need some things to change. Okay, so that is available. Kitty can put that link in the chat. And then the logistics of getting the recording are something that Kitty is going to take care of as well. So I'll just let her tell you about that. One thing I did want to note is with the recording will also come this handout sheet that we have been going over. And the handout sheet includes the glossary of terms, the profit and loss, the balance sheet, and the cash flow statement.
Yes, and those will all be coming tomorrow. So you can expect that tomorrow, probably 24 hours after. So probably noon tomorrow. And we did have one more question just come in. So cash flow does not show existing cash, but expenses.
That is, it does show existing cash. It shows it.
Cash on hand.
Yeah, cash on hand.
Okay. So yes, the email you'll receive tomorrow will have a this video that you've watched today, if you want to rewatch it and catch up on some things that you might have missed. And it will have the handouts that Angie referred to and the link that Angie talked about to set up a free profit assessment with her.
All right, thank you, everybody. Thanks for joining today and good luck. I hope I've decoded some of your questions and you can read your financial statements a little bit better. Thank you.